Welcome to this lesson. I'm CPA Gaitho. In this lesson, we are going to learn about source documents and three-way matching. Kindly subscribe to this YouTube channel, Treatise of Accounting Information Systems, and remember to hit the notification bell. Our objectives for this lesson is to learn about source documents and three-way matching. In source documents, we are going to define a source document, see the features of a source document, go through a sample source document and various types of source documents. In three-way matching, we are going to define three-way matching, go through the components of three-way matching, and the benefits of three-way matching. A source document is a record that is kept as an evidence of financial transactions. It is the original document that contains the details of business transactions. The objective evidence concept of accounting requires that every accounting transaction must be supported by a properly documented evidence that is prepared before the transaction is effected. That evidence is in form of a source document. Therefore, the purposes of source documents are to provide evidence that a transaction occurred, to ensure that the entity maintains good internal controls, and to document procedures followed in business transaction. A good source document should describe the basic facts of the transaction, such as the transaction date, the amount involved, the purpose, and all parties involved in the transaction. The features of a source document are name, address, contacts, and details of the supplier, name, address, contacts, and details of the customer, identification details and signature of the personnel involved, steps and procedures adhered to in preparation and authorization of the source document, date and time of the transaction, type of the source document, unique identification number of the source document, reference number of related documents, description of goods, services, or works including unit of measure, details for terms of payment such as credit period, modes of payment, applicable currency, quantity, price, and amount involved per item, total gross amount, tax thereof, and net amount, other applicable terms and conditions, and any other relevant message to the customer. This is a sample customer's invoice. From this sample customer's invoice, we are able to see that all the 16 features of a source document are there. That is, there is suppliers and customers identification details, addresses and contacts, the types of invoice, the invoice date and the invoice number, the reference number for the related quotation, order and delivery note, the currency is Kenyan shillings, the particular description of goods including the unit of measure, the quantity, price, and amount for the respective goods, the total amount, VAT tax thereof, and the net sale amount. The terms of payment is 30 days credit and the due date is there. The acceptable means of payment are M-Pesa and check. The applicable terms are that errors and omissions are accepted and that goods once sold are not returnable. The procedure followed involve preparation, verification, and authorization. There are details of the respective personnel involved in the procedures. And lastly, a message to customers that thanking them and welcoming them again. There are various types of source documents that are used by entities to support their accounting transaction. The designs and formats of source documents varies from one entity to the other. Such source documents include but are not limited to receipts, invoices, debit notes, credit notes, imprest warrants, financial claims, and payment vouchers. A receipt is an evidence that money was received. A receipt should document the person who received the money, the person who paid the money, the amount received, the mode of payment, and the purpose for the money. There can be two types of receipts. A cash sale receipt that documents receipt of cash and the sales, and a cash receipt. An invoice is a demand for payment. There can be two types of invoices, that is, a credit invoice and a pro forma invoice. A credit invoice is an invoice for an obligation that has already been performed, such as customer's invoice, supplier's invoice, and fee notes. A pro forma invoice, on the other hand, is a demand for payment for an obligation that is yet to be performed. A pro forma invoice gives rise to contract asset and contract liabilities. A debit note is evidence that supplier's obligation has been reduced. In case an entity realizes that the supplier's obligation is overstated, for instance, as a result of invoice received from supplier for an amount that is not received, the entity issues a debit note to the supplier to inform them that they have reduced the invoice. A credit note is evidence that customer's debt has been reduced. In case an entity realizes that the customer's debt is overstated, maybe as a result of invoicing for goods that has already been returned by the customer, the entity issues a credit note to the customer informing them that they have reduced the debt. Both debit note and credit note are used to record returns of goods to seller by buyers. Some of the reasons why buyers return goods are goods being of inferior quality, goods being not according to the order, goods being not according to the sizes, goods being not fit for use, such as goods arriving after the intended function, and damaged and defects goods. An imprest warrant is a system of an entity advancing cash to its officers as a way of facilitation to perform an official duty that is outside the normal processes or the normal routines. The officer must account for the imprest advance after the official duty is completed within the specified period, else the money advanced may be deducted from their salary. There are two types of imprest, that is, a standing imprest and a special advance. A standing imprest is an imprest that is replenished on a regular basis, such as a petty cash imprest that is replenished on a monthly basis. A special advance imprest is a one-off imprest, such as traveling and subsistence imprest while traveling on official duty. A financial claim is a demand for payment for a right or an obligation that arises when certain specified circumstances in a contractual relationship between two parties are met. A claim can either be internal or external. An internal claim is a request by an officer within the entity, such as overtime claim by employees. An external claim is a request by a third party, such as an insurance claim to an insurance firm. There are two types of claims, a reimbursement claim and a compensation claim. A reimbursement claim is a claim to be refunded for an official duty incurred on behalf of an entity. A compensation claim is a request for payment for some benefit that you are entitled to, such as sitting allowances to directors. A quotation is a document that the seller provides to a buyer to offer goods or services at a stated price under specified conditions and requirements. Normally, the buyer makes request for quotation specifying the conditions and the requirements, and the seller replies with a quotation stating the prices. An order is a document used to record the expression of interest by the buyer to buy and be supplied with the specified goods from the seller at the seller's stated prices. There are two types of orders, that is, a purchase order or supplier's order and a sales order or customer's order. Goods received note is an evidence that the entity has received, inspected, and accepted goods sent by the supplier. When an entity makes a purchase order, the supplier delivers the goods. The entity receives the goods by signing the supplier's delivery note, inspect them to confirm if they meet the requirements as specified in the purchase order, and then issues a goods received note to document the receipt of goods. Goods returned note is an evidence that the entity has rejected goods and returned them to the supplier. When an entity inspects the goods and finds that they are not as per the order or they are not fit for use by the entity rejects them and issues a goods return note to document the return. A dispatch note is a document used to record goods that have been released from the warehouse or store for the purpose of shipping to the customer. Goods can either be dispatched to courier services provider, shipping department, or to the customer himself. A delivery note is a document that accompanies shipment of goods to the customer's premises. The customer signs the delivery note to acknowledge that goods have been delivered and received. An inspection note is a record that shows that goods received from a supplier are verified to confirm that they are consistent with the order, they meet the specified requirements, and are fit for the entity's use. Inspected goods can either be accepted or rejected. An acknowledgement note is a record issued by an entity to formally acknowledge the receipt of a certain document, such as an invoice. An acknowledgement note can be used as a courtesy for record keeping or to raise an issue with whatever service was received from a supplier. A requisition note is an internal document used by the user department to request for specific goods that are needed in their operation from either warehouse or purchasing department. For instance, a production unit may request for materials they need to complete a manufacturing process. An issue note is an internal document used by the warehouse department to record movement of requested goods from warehouse or store to the user department. For instance, issue of requested raw materials to the production unit. A bin card is a document that helps in the management of goods in a store by recording goods received, goods issued, and outstanding balance. Bin cards are normally placed next to goods on the shelf. A bin card is useful in a perpetual inventory method whereby inventory balance is maintained. A fixed asset register is a detailed record of properties, plants, and equipment owned or controlled by an entity. It helps an entity to track the book value of the asset by keeping a record of their costs, depreciations, devaluation, and impairments. Fixed asset register helps an entity to track, locate, and identify each specific asset. It may also be useful in scheduling of asset-related activities such as servicing, repairs, insurance, calibration, and warranty period. Certificate of works completion is an evidence that contracted works have been completed as per the requirements. Normally, in projects, the project administrator verifies the works that have been done against the requirements, and when satisfied that the works have been completed, he issues the contractor with a certificate of works completion. A job card is a detailed description of work that is performed for a work order. When clients request for a service, the work that is done to serve them is documented in a job card. An employee's payslip is a document given to an employee by an entity detailing their respective earnings, deductions, and net pay for a specific period. Earnings comprises of salaries and wages, cash benefits such as house allowances, and non-cash benefits such as a car. Deductions comprises of statutory deductions such as pay as you earn, and voluntary deductions such as bank loan repayment. In net pay, the entity must specify the mode of payment. A deposit slip is an evidence that money has been deposited in the bank account. This can be in form of cash deposit or checks deposit. A withdrawal slip is an evidence that money has been withdrawn from a bank account in form of cash. A share certificate is a document used by a company to issue paid-up shares to its shareholders as an evidence of ownership in the company. A share certificate specifies the name of the shareholder, the class of the shares, the number of shares held, and the par value per share. A dividend warrant is a special check for payment of dividends sent by a company to its shareholders through their registered addresses. A dividend warrant can easily be converted into cash in a local bank just like a regular check. A payment voucher is a document used to record evidence that three-way matching of the expenditure has been done, proper authorization procedure for payment has been followed, and the mode of payment used to disperse the money. There are two types of payment vouchers, that is, single payee voucher and a batch payment voucher. In a single payee voucher, one or more invoices of a single supplier are paid using one payment voucher, while in a batch payment voucher, multiple payees are paid using one payment voucher, such as monthly payroll voucher. A petty cash voucher is a document that is used to record cash purchases of miscellaneous goods from a local supplier that do not require a purchase order. For instance, purchase of bylaws from a local canteen. Three-way matching. Three-way matching is a process of comparing order, delivery, and invoice before making payment. Three-way matching process ensures that all invoices are vetted before payment is made. In three-way matching, the entity ensures that goods that have been invoiced are the same goods that were ordered and are the same goods that were delivered. This helps in eliminating fraud. Basically, in three-way matching, the entity confirms that the invoice matches with the order and matches with the delivery. In case of payment for goods, the components for three-way matching are purchase order, goods received note or delivery note, and invoice. In case of payment for services, the components of three-way matching are service order, job card or work ticket, and fee note or service invoice. Lastly, in case of payment for works, the components of three-way matching are the contract, the certificate of work completion, and the contractor's invoice. When making payment for goods, services, or works, the entity should ensure that the payment voucher is always supported by the components of three-way matching. The benefits of three-way matching to an entity are: it helps to eliminate fraud in the payment process. It ensures transparency in the entity's expenditure. It helps to keep a verified record of suppliers and their related expenses. It helps to eliminate unnecessary expenditures. And it helps the entity to maintain adequate records for audit trail. Thanks for watching. Remember to subscribe our channel, Treatise of Accounting Information Systems. Like this video, leave a comment and share with others.